afternoon, and thank you for joining us for the long-awaited renewal of ROK webinar. The company trades under the ticker symbol ROK on the TSX Venture Exchange, along with freely tradable warrants at an exercise price of 25 cents, which expire March of 2025. The team has been extremely active in the A&D market since Q3 and has subsequently evolved into a completely different story than what we first showcased in April 2023. With us today are President and CEO Cam Teller, COO Bryden, Wright, and CFO Lynn Chapman. The presentation may contain forward-looking statements. There will be an opportunity for a Q&A after the presentation, so please put your questions in the Q&A box or email me at jessica@adcap.ca. Guys, I think best to dive into what you've bought, what you've disposed of, the consolidated reserve value, and what we can expect for the balance of the year. So Cam, I'm going to turn it over to you, and you can start with your updated strategy and how the company has changed and where we see things going forward.
Thanks, Jessica. Yeah, it's been a busy year for us. We started about a year ago with a big acquisition. We used debt to purchase about 3,000 BOE a day, scattered across a number of properties in Saskatchewan and Alberta. We purchased that for about $60 million net of adjustments. And in this past year, we've now sold off $74 million worth of non-operated properties and reduced our debt down to $10 million and growing our core area in Southeast Saskatchewan. So a lot of activity, been a busy year for us. The company now is consolidated into a high working interest set of assets with a focus in Southeast Saskatchewan, about 2,400 BOE a day there, and 1,350 in our Kaybob area. Debt, I guess just jumping to what we see happening this year, we're back into the mode we like to be in, where we have a lot of drilling locations. We're going to be starting a drilling program here in June, and we'll be drilling on these properties. We expect to get to 4,500 BOE a day for Q4 and have the debt down below 10 million at year end. So a company with good, strong core area focus and low debt and a great drilling program out ahead of us. So I think kind of back to what we're built for as a team, and looking forward to growing the company. Just going to scroll forward here for Bryden to just talk about that forecast a little bit, and also the acquisition that we did to grow our Southeast Saskatchewan area.
Thanks, Cam. Yeah, so this last quarter has been extremely busy. We picked up, a bunch of assets from Whitecap that we are extremely familiar with. A lot of wells we actually drilled or were partnered on in a previous iteration that Cam and Jared and I were a part of. And so it fits our, core Southeast Saskatchewan area very well. It's a combination of Frobisher and Midale inventory. And what we recognized as we moved through the end of 2023 was a couple of things that we wanted to address. Number one was inventory count, running room, how do we continue to grow with our existing assets? And then number two is just the amount of leverage that we were carrying as a company. So this first Whitecap acquisition and swap of assets, so we did sell some of our non-core, non-operated stuff out of Southwest Saskatchewan. We did that, and in our opinion, we've added significant growth potential and a number of locations, and you'll see that in our latest press release. We've gone from just over 50 locations to up over 120 booked locations. This slide here shows our core areas. This will be updated shortly, just for everybody's information. This hasn't been updated with the new locations, but it's only changing moderately to the upside. So, Pinto, Alameda, Glenview, and Florence, those are our core areas post-transaction. That's where a number of Frobisher and Midale locations exist. And then on the Benson and Steelman side, as you move a little bit further west, another area that we're going to be, drilling up a little bit here in the next 6 months. So if you go back up, Cam, go back up to the forecast quickly. So as we move ahead into the second half of 23, we're expecting to drill 11 gross wells, grow our production currently about 3,750 BOEs a day up to 4,500 BOEs a day. So that's a budget of roughly $30 million. And, as we focus on the Midale and the Frobisher, I think, we love those two plays because you have these high IP potentials, with both of them, with the Midale obviously having a little bit longer reserve life and longer EUR or larger EURs. But as we push forward to the end of the year, the reduction in our debt will continue. And so currently we're estimating about 10 million net debt. We're showing 17 on this deck. This will be updated in the next few days, and we'll have this updated for the market. But we have brought that down a little bit further from this estimate. And, we expect to be term debt free toward the end of Q2. And, we'll just be sitting with a line of credit with some additional room and an ability to, be predatory if we see M&A opportunities, but also have an ability to drill more wells if that, if oil prices or gas prices continue to rise. So as you can go down, I guess, to the map even, Cam. This is a snapshot of the Whitecap acquisition, offsetting our existing land base that we acquired from FCL, as well as some previous lands that we had already owned. You can see the fit from a geographic standpoint. Obviously, it's buttoned up next to a lot of our existing land base and a lot of the lands that we know very well. So as we push into June, July, as we start to drill, we will be drilling a number of these lands that you see on the map, both Frobisher and Midale. And I think we have seven or eight of the locations planned are conventional Frobisher wells. So that's that, million type CapEx. And then the remaining 3 or 4 will be frac Midale wells on some of our, favorite plays. And, we've always been talking about these Frobisher curves and what the economics potentially look like. Obviously, we'd love to drill, the 300, 400 barrel a day IP rates like we did at Florence last year in July. There's definitely a few of those that we're hoping to drill this year. I think, when we look at our type curve, it's a 110, 120 barrel a day IP 30. We come in on our forecast a little bit under that. And even using that type of curve, phenomenal IRRs, anywhere from 300 to 500% at $80 and up, payouts of 4 to 6 months, and recycle ratios above 3. I think it's the second best economic play in Western Canada behind the Clearwater, I believe. And obviously we want to continue to grow this inventory. Our plan is to go and drill some of the lower risk locations, but also try and step out and increase our reserve base as well in this area. And then the Midale. So now we've added a lot of Midale inventory. So these are frac locations. We built and sold our last 2 companies prior to ROK on this exact type of play. So we know it very well from a technical standpoint. And, there's some fairly low risk infills and step outs that we plan to go and take advantage of here. And, hopefully $80 price. I know we've come down a little bit in the last few days, but, we're pretty bullish on where oil prices are going. And, even at $70, you're in that 50% IRR. And as you get up over 80, you're getting close to 100% IRR on these Midale wells. So, very economic. Water flood upside. Some of these pools are already under water flood, and we're starting to see some positive benefit from that. So, overall, we're really excited about the inventory we have. We're continuing to pick up strategic land, looking at, competing at land sales and always looking at tuck-ins from an M&A perspective. So lastly, the one thing that, kind of came out of, I'd said previously that at the end of 23, we were concerned about 2 things, our our leverage, and then obviously our inventory. So we addressed the inventory to a degree with the Whitecap acquisition. And then we sold our Weyburn unit interest for about $45 million. And, with that, we sell a PDP asset, right? It's a 450 barrel a day net to ROK, flat, essentially no decline. So you're selling a valuable PDP asset, but there was very limited upside there. And we were able to take that and put it right toward our balance sheet and put it toward debt. So we have reduced our cost of debt significantly in doing so, from 16 down to 8%. We'll be term debt free, estimated in June. And it just gives us so much flexibility from a capital perspective. It opens up about $2.5 million a month that we were putting toward this debt, both principal and interest. So that we can put into the ground. We can look to do M&A. We can look at options, obviously, as we get into 2024 with that capital and with our free cash flow that we'll be producing. So that was a quick run through of the inventory that we've now built into the company in Southeast Saskatchewan specifically, how the balance sheet's improved, and I guess how we're very optimistic about the go forward plans that ROK has.
Okay, that's great. Let's quickly touch on the reserves that came out today. Yeah, you had a nice jump in your 1P and 2P, but obviously the PDP number came down with as a result of the sale of the Weyburn unit and production that you sold that you had last year. So with the new drilling program for the 10 to 11 wells you plan to drill this year, how do you foresee that adding to PDP for this year?
We're seeing about $3 to $3.5 million NPV 10 on every one of those wells we drill. So there's a $30 to $35 million PDP add on a drill program like that. We'll be producing through that year, so there will be a net impact on the PDP at year end. But at this current oil price, gas price, it's sitting $3 to $3.5 million per well drilled of PDP value.
So which is pretty significant considering what you on an overall aggregate basis. So you should be able to make some pretty good increase to your PDP, I would think, through your drilling program this year.
That's the goal. I mean, obviously selling that PDP from Weyburn was substantial, but what we did was replace or add a significant inventory on the PUD and probable case that we think are fairly low risk, and obviously cleaned up our balance sheet significantly. So the plan is to go and convert some of those PUDs and probables into PDP, as well as drill up a few new areas hopefully and add it from that perspective as well.
So on the drilling program that this year, is it mostly going to be, like you kind of touched for a second there, Bryden, on the drilling program? Is this going to be more, you said, a little bit more infill as opposed to step out kind of focused?
Yeah, it's a combination. There are, a few wells that we've identified that are, in unbooked portions of our asset base, where I think we can add some barrels, both from a production and a reserve standpoint. But we're definitely targeting some of the, a few lower risk locations that we think are good production adds, good PUD to PDP conversions. And that's specifically on the Midale case, where there's a number of locations booked, a number of upside booked locations that were left by Whitecap that we think, in $80 and up are really attractive targets.
Okay, and so 80 is kind of the price where we could see you accelerate your drill program this year, or do you think you'll stay with the 10 to 11 wells and then?
I think 10 to 11 is where we're targeting right now with the clarity we currently have on pricing, but there's, we're paying that term debt off. We free up $2.5 million a month of cash flow, and we have lots of capacity financially now. And so as prices go up, you could see us accelerate a drill program.
And so speaking of that, you have, about 92% of your oil hedged at $82, so as a result of the term debt that you had taken on, which is now basically being paid off as a result of the sale of Weyburn, which left you at that point, prior to the, taking down that term debt, you were somewhat limited on your drilling ability. Can you give us a sort of view of your, because 92% of your oil production is a lot to be hedged, which, most companies wouldn't do, but that's required under the term debt agreement. Now that that's changing, how do you foresee your hedging program going forward? And would you take off some of those hedges that you have on right now? And what's your strategy in general for hedging?
So the term debt required a 24-month hedge of 75% of PDP. When we pay the term debt off, we'll not be required to carry that kind of hedge book. So we'll target a 12 to 18 month hedge, probably on 50 to 65% of production, just to protect our capital program. So that'll be a target. Obviously, we have some steps to take here, paying off the term debt and looking at which hedges can be unwound, and we'll be working on that over the next 3 months.
Okay. And I think one thing that's really important, like you're offering a pretty significant growth for a company of your size on a percentage basis and overall barrels. But even with the disposal of Weyburn, what's your current corporate decline rate?
We're about 20%. And so when we had the Weyburn unit within our suite of assets, we were in that 17-18%. So obviously removing a 500 barrel a day flat 2% decline asset will jump your decline a little bit, but we're still in a comfortable position at about 20. And so as you look at our growth over this year, I think we're planning to exit with about a 20% growth profile, I believe, on top of that, right? So we have the ability to add barrels.
Without really increasing your decline rate that much.
Yeah, I mean, they'll, obviously
it's subsequent to, yeah.
In the early months, they'll come off. If we went out and drilled 20 or 30 wells in a 6 to 10 month period, your decline would go up, in the short term. But we do have a fairly significant PDP base. There is a lot of historical production in this asset from both the FCL side and the Whitecap side, right? And some of that is underwater flood. So it's not an immature asset by any means.
And I think we've discussed this before, but not a lot of money planned there's no real spend plan for water flood at this point, just kind of let them go as they are. And
so, yeah, we actually do have a water flood project that we have approved that we're going to kick off in the Benson area this summer. So that would be one area, and that's, for the most part, that's just conventional production out there. It's not a fracked play. I think there's one fracked well in the area. So we will kick that off. I think it's a bit of an older pool that could definitely benefit from some pressure maintenance. So that is a plan. It's not a big dollar figure, but we do believe it'll help stem some of the declines out there.
And what you're just going to convert some producing wells? Is that plan? Okay.
It's Bryden, it's about a $1.2 million CapEx on the facility just to use existing wells to inject water, right?
Yeah, not even. It's about $1 million. Yeah. Mm-hmm. So we have 2 wells to convert, some disposal line work and a bit of a facility work. And so hope to have that done by middle of summer, and then, it'll take some time to see a response there.
Yeah. What do you expect? Like 6 to 9 months for response time? 6
to 12 months. Yeah.
Okay. And then, what are your current tax pools?
$90 million of tax pools.
90 million.
Sorry, I had to find the mute button. Yeah, $90 million.
Okay, that's extremely good considering so many other companies are facing taxability. You've got a ways to go. ARO, given you know, again, the sale of certain assets. I'm certain there was probably some good ARO associated with Weyburn. I'm not 100% sure, but I'm assuming as much.
There was some ARO there. So our corporate ARO today sits at about 68 million, and that's undiscounted, uninflated. That's where we sit. And we have a budget, you know, an internal budget of about $2 million annually that we put toward ARO. So it's quite aggressive. When you look at our provincial requirement between Alberta and Saskatchewan, it's about $1 million. So we double that every year. And, you know, obviously we're quite active in terms of trying to retire those assets in a quick manner.
You've kept your map pretty vague, and I'm assuming that's for strategic reasons and why you're not showing us exactly where you're drilling. So you probably don't want to take a deeper dive into which areas on that map you're doing most of your drilling, I'm assuming.
No, it's fine. It's just, it's not like a monkey pad drilling where you can, you know,
I know that. Yeah.
like that. So, but in general, there's a Frobisher fairway that starts down at Florence, Glen Ewan, goes up through our assets at Steelman, Pinto, then Steelman, then into Benson. So throughout that fairway, without sort of drawing every circle on the map, there's actually wells in this program in each of those areas, and we'll move each of those prospects forward in that Frobisher fairway. The map that we did show to show the synergies of the acquisition, all of the Midale holdings that are core to us are in that area, with the exception of one, which is at Workman. That will be, we're just offsetting a competitor's recent drill that we're just protecting our turf on. So yeah, it's something we're definitely not hiding it. It's just there's a lot of gory details sort of beyond the scope of what the time we have here.
You've done a lot, you're absorbing a lot. What is the landscape like right now? Do you see a lot of assets for sale, or ones, and you probably still have some dispositions you might think of doing, like smaller? I'm not sure. What's your view on that, and what's out there for sale, and anything that's of interest?
Yeah, so first of all, on further dispositions, we still have some non-core stuff. It's getting smaller. There's no real big pieces, but there's still a few at the right price that we would sell that are, if they're in the non-op category and non-core. But that pool is getting smaller. We're pretty much down to our operated core now. So you might see us trickling some small $1 million pieces here and there out the door, but nothing substantial, I don't think. The M&A, you know, we pay a lot of attention to our core areas, and there's assets for sale in there. I think one of the issues is that even if you take a look at year-end engineering price decks, they were quite high relative to, for example, this price deck that we just did our recent report on April 1st. Gas in particular has gone way down. And so I don't think that it's a real attractive price deck and moment in time for sellers, but I believe we'll see as we go into the third and fourth quarter, some of the, in particular, the privately held corps that have been sitting on investors' money for 7-8 years. We'll start to see those trickle out. And I think that'll accelerate if we see any strength in oil prices. So we would expect to see some of that, both on the small scale, like down in the $5-6 million range, just private individuals hold those types of assets, all the way up to some of the recently announced private cos that are for sale in the, you know, in the 1,300 BOE a day range. So I do believe we're going to see assets for sale, in particular in the Southeast Saskatchewan.
Would you consider, like, you have a lot to absorb right now, and would you consider doing something as sizable as you just did with Whitecap, or would they be like, I guess if the perfect thing came along, you'd have to consider it, but you know, given what you've bought and working through right now, would you rather just spend some time absorbing what you have?
So we have no targets in our sights right now. We're focused on absorbing those assets, getting the drill program off and running. And so that's what we're focused on. As you pointed out, if there's something for sale at the right price, then you have to be smart and think about it, but we have nothing in our sights right now.
Okay, so that leads to one question from the audience. As the debt number declines this year, do you intend to return any cash to shareholders via dividend or buyback program? Or will the majority of free cash flow be used to add barrels via drilling, M&A? Under what backdrop would you return it? Under what backdrop would returning cash be the most likely?
Yeah, there's no plans in 2023 for dividends or share buybacks. We're going to focus on the drill bit and the growth. That question is going to come up in 2024, and we'll have to take a look at the price environment and make some decisions then. But I don't want to speculate on what various scenarios would lead to one or the other decision. It's a 2024 decision for us.
I mean, speaking as a shareholder, I expect from my smaller companies like yourself, growth is usually more of a focus for like I buy a company like you for growth. I might buy something else for, a dividend. So I just my personal opinion for smaller names, if you can deliver more value through the drill bit than paying back, you have to run those economics and see what works best. I mean, if we continue to see pressure on stocks, maybe a buyback is the more important, the more economic approach or what have you. But and then another person asking if you have any plans for a warrant buyback program, which we've discussed to death and have not come to a conclusion at this point.
Yeah, that's the thing. There's a lot of variables out there, a lot of opportunities. So I just know that for 2023, that's not part of our current plans. So we're gonna, I guess, focus on that drill program and kind of watch what everything's doing in the marketplace, and then make some decisions in the future.
Oh, and then just on your reserve type curve, is that 1P or 2 or P plus B?
No, those are P. That's your 2P like reserve barrel number. So it'd probably be about 80% of our kind of tier 1. So it would vary from, say, on a Frobisher well, 60 to 85, 60 to 90,000 barrels, something like that. And then same with on the Midale. So I think we show 68,000 barrels. So that is a 2P number.
Okay. Let's just touch quickly on the lithium. You own 25. You've had some great results out of your Bryden lithium. You own 25% of Hub City Lithium. Now, this is not a main focus for you guys. I know that going forward. What is the strategy surrounding your lithium ownership?
Yeah, so we're, I think we drilled the best lithium well in Canada before Christmas. There's a big resource, very heavy density. It's got a lot of value. But for us, it's a fairly straightforward project that's right beside our Benson project. And we've drilled one well, and we're going to do some testing there. We believe there's a lot of potential value moving forward. So this is really an exercise. It's a free option for our shareholders. And it's an exercise for us in 2023 to figure out how to best monetize that on behalf of our shareholders. And a lot of discussions with our partners on how to do that. The initial steps, though, are we'll get a resource report out that's just sort of being finalized, and get that out so people can kind of see what we see technically. We're engaging a firm to go into a PEA and get some economic parameters put around it. Hopefully have that out here in early summer. So I think once people see the scale of the resource, the economic parameters, then there's a conversation can be had about what the value is and how do we get that into our shareholders' hands one way or another. So continue to believe that it's a very simple operation for us to move this forward and increase value without it being a distraction to our oil business. And it's a free option for our shareholders right now. It's not really part of the reserves or cash flow picture, but we believe it's going to be significant. We just have to kind of continue to stick handle it forward until we have a way to get that separated out of the company and monetized on behalf of our shareholders.
I think this might be a difficult question to answer right at the moment, speaking of which, given you're just doing the PEA and there's still a lot of unknowns as far as extraction, etc. But what would be the cost from start to production to become a lithium producer? I don't know if you can answer that right at this moment, or if anyone can answer that.
I mean, I can answer it if I ask 5 questions. Like, you know, these are all staged. There's billions of dollars of lithium carbonate equivalent within our reservoir. And so getting it up and running at 2,000 tons a year is a different number than ultimately at 10 or 20,000 tons a year. So it's really about how you stage it. And I think the way we will handle it within the PEA calculations is to take a small capital investment to get initial cash flow and then use the internal cash flow to build the project up. But you know, lithium price at the time is going to dictate how aggressive a company gets after that, and it's also for us to decide whether we're an owner at that point. But that capital, there's so much lithium resource in place. It's really about pace of capital and how you layer in.
And what's your capital allocation for your lithium for this year?
So we have about $750,000 total invested in this so far. Bryden, what do we have in the forecast for 2023 on that?
I think it's another $750,000. So we've allocated enough to drill 2 potential wells as a 25% partner, and then take part in the PEA and the resource study. So it's a fairly nominal amount of money, for the potential upside down the road. And to date, like to Cam's point, we've invested very little capital. Essentially,
but again, this really depends on it's this cost risk reward calculation that we're constantly doing. So we've got 750,000 in it. We're looking to spend that much again to get through that PEA in an intelligent way. And then we have a decision to make in the last part of the year. Is there more work that needs to be done, more money that needs to be spent to extract value, or have we got what we need? It's going to be step by step on that.
Okay. 1, it's been amazing as best as I can determine. 2, oil prices minus $10 from today's price will have the biggest impact. If oil stays at 75 to 80 for the next 12 months, if you spent 10 million of corporate dollars, where would you see the biggest return on investment?
Drilling Frobisher wells.
And so you historically have been, serial sellers, given the, timing that where you built. And I'll just actually, before I go there, another question. How much land do you hold on lithium?
I think it's 225,000 acres, something like that. And one thing to frame to the lithium resource, there was a sale of a private lithium company that offset us, bigger land base, but very similar rock. They didn't have the concentrations as high as ours. So they just sold their company for about $70 million. So there's value in just the resource that's being extracted today. But to answer the question, I want to say it's 225,000 acres.
It sort of causes me, though, there's sort of an early stage part of this lithium business that we've seen where people talk about massive acreage counts and they add up a bunch of 70 to 80 milligram per liter land into some number, 1 million or 4 million tons in place over, a tenth of the province. that is not at all what we're focused on. We think of this as where is the highest resource density, smallest footprint, highest netback project. And that's what we've been after. So I'm a lot more interested in what my lifting costs and trying to be the lowest cost per ton producer. So everything you'll see from us is not going to be promoting. We have a pile of acreage that is not in our sites right now. We're very focused on what is the most valuable, highest rate of return place to go put initial lithium capital. And so
We actually divested of one of our areas that had about that 70 to 80 milligram per liter type concentrations, because our focus is in this Viewfield Manser area where we see 100 to 250 milligrams per liter.
So you'll see when we get some of our material out on resource and that, we're very focused on tons per square mile and what is the density of that resource, and that relates directly to capital costs. So developing a square mile of brine extraction like we do in the oil business at Benson right beside us, there's just a capital cost per square mile to get that brine to surface, and I want as much lithium tonnage out of that as possible. So
capital and operating
focused on value density, not acres.
Now, given everything that has occurred with your acquisitions and dispositions, you've actually become a better value proposition than you were even like at the end of pre-doing your Whitecap purchase. Certainly from pretty much every metric except for on a PDP basis. Just again, and we've discussed that already. But on a EV/EBITDA basis, you're one of the cheapest names out there. On a net debt to EBITDA, and I mean you have way less debt. I mean you're going from 10 to what, 6 million, 4 million bucks by the end of June sort of thing. And or if that's what you decide to, whatever you decide to keep your debt number at. And if you look at where you were last year at this time, even at the at year end before you bought the Whitecap assets, your debt was significantly higher, yet your multiples have compressed. Now some of that is market related, but and this leads into my serial seller question. I mean, given how much value you're offering right now, it would kind of be a shame to see you want to sell into this environment. I would think, given the longer term macro positives we see, at least I see that. I think a number of others do for the next at least 3 to 5 years. And in that question, given your current land base, how much production growth do you like? What would be your maximum production do you think you could get out of the assets that you have at this current time?
So production wise, the current asset at current prices, we think this 4,500 BOE a day number is a number that we can grow to and sustain for a long time. We have a lot of optionality at Kaybob. As oil prices and gas prices go up, then we have the ability to grow that area and get ourselves up to 6,000 BOE a day. So there's additional growth, but we don't think we'll pull the trigger on that until we see higher prices. And each individual well and play, there's a stack of 8 reservoirs there. Each of them has their own economic run, and it's all about a lot of high flow rate initial production and putting that payout period in a high price. So each individual wellbore would have its own trigger point. So there's a ability to grow on the existing asset if we buy no other land, sign up no other freehold, or do no acquisitions. I think we're going to stay on the hunt for good opportunities. We're busy growing that land base, trying to grow that platform. So but that's the type of range we're in if we didn't pick up any additional land. On
So
you
could on that though, sorry to interrupt, but do you not see with what you have, unless, let's say commodity prices stay where they are, so therefore Kaybob's not that sexy at this point. So you're stuck mainly drilling your Southeast Saskatchewan assets. Could you see yourself growing 10 to 15% a year for the next couple of years without adding any new acquisitions?
Yeah, we can drill more, accelerate production growth, and produce the reserve base out quicker. Like we have optionality to continue to grow without doing that. But the natural thing is we are continuing. So we have a reserve life index on that asset the way it sits today with no new land. Some of the wells we're drilling will increase on that base, that reserve life index. So yeah, there is the ability to accelerate on the existing asset base. But the business plan is definitely, like, we continuously add. We added a lot of land in the portfolio here over the last 12 months, and we'll continue to pick up additional acreage. That's really been the history of us as a group, is to constantly grow that raw land base and grow the production base as that grows. So,
Jess, to answer your question about selling in this market, I mean, we have no urgency to sell. We have no reason to go and sell. We trade at 2 times or sub 2 times cash flow, and that's where you want to buy and not sell. So, our focus is just, and our scorecard will continue to be dollar per share growth. How do we increase the value of our shares for our shareholders? Which, in fact, Lynn, Cam, myself, Jared, our insiders own 17% of this company. So we're hyper focused on per share growth, and we believe we're undervalued. We believe the whole sector obviously is not maybe getting treated as we would hope right now by the market, but we think that will come and prices will continue to rise, and and we'll grow, whether it's through the drill bit, through M&A for the right opportunities, and try and grow that per share value for our shareholders. And when the time comes to sell, the market will tell us, and we'll know internally that our assets are ready.
Okay. And on that note, what do you see as the biggest risks going forward?
commodity price is
Something you can't control.
fundamentally, that's fundamentally the biggest risk.
Yeah, I think we can control the industry we're in is risky. We take risks all the time with the wells we drilled. We take risks with commodity pricing. So we'll continue to hedge to protect that capital program, protect debt if we're carrying debt, and we think we'll probably always carry a little bit of debt. We think that's prudent. We always want to have access to capital, whether that's through debt or equity if we ever need to do that. But yeah, I think really it's just commodity price, ensuring that we protect that balance sheet to some extent, but can also take part in any big bull run that we expect to see.
I think the biggest impact, we can manage CapEx expenditures. We can take a look at what commodity prices are and react by spending or not spending money. And we can hedge to protect the short term, so we have some flexibility. But when you're looking at reserve reports, the December 31st gas deck that was used by evaluators
The prices were much higher. Yeah.
Yeah, and so the gas deck that we just used for April 1st effective date stripped a lot of value out of the forward reserve NAV for those gas reserves. So those types of changes in the commodity price play with your future reserve value a lot, and so your reserve report in 4 months goes down if the deck goes down. So that's the type of thing that's hard to manage in the short term, but we can protect ourselves from short-term fluctuations and then adjust CapEx to react. So not too afraid of it in terms of operationally how we deal with it. It just yo-yos your valuations a lot.
Okay. Well, I don't have any more questions, and nor from the audience. Anything we didn't touch on that you guys would like to highlight?
Nothing for me.
again, I'd just like to reiterate, I mean, I don't think there's any other company out there with the skill set that you guys have at your size level with the drilling inventory that you have trading at this valuation. And so, I mean, it's, you're perfectly positioned now. So there's, I mean, I don't see why there wouldn't be a lot of new eyes looking at your name.
Yeah,
So-
I
no,
appreciate that.
You've
Yeah,
done a really
thanks.
good job getting the company to a fantastic position. So, as a
Yeah,
shareholder.
Yeah, I think it's
thank
on
you.
us too, to go out and tell that story a little bit. We've kind of been head down for the last 6 to 8 months specifically on these deals and, doing things like this with you, Jess, and, we were down in Phoenix, Jared and I doing an investor conference, and Cam and I in Houston doing a luncheon, and, additional things coming up over the next few months. Hopefully we continue to get the story out and then obviously have some success as the year goes on and get some more eyes on the story.
Yep, no, I think you've done a fantastic job. So congratulations and thank you very much for your time. If anyone has any further questions or needs a follow-up with the company, please feel free to email me at jessica@adcap.ca. And other than that, have a great afternoon.
Thanks, everyone.
Thanks, guys.